Welcome everyone to Vested Interest. This is Shane back for a stock pick of the day video. It is March 11th, Tuesday. We're going to take a look at Texas Instrument. This is out of the information technology sector. This is a chip manufacturer here. We have looked at them in the past, but it has been a while. Before we get too far in the video, if you could do me a big favor, it doesn't take but a couple of seconds of your time, but it really does help out a small YouTube channel like mine with the YouTube algorithm. If you could hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click the notification bell so you're notified whenever I put out any new content. I do this stock pick of the day video series Monday through Thursday when the market's open. We take a look at a company stock that's pulled back on the day, run it through the screener, and see if it makes it onto my watch list. We'll check out that screener at the end and see how this one shakes out. And there is the thanks button down below for anyone who might want to help out the channel and buy me a cup of coffee or a cup of tea. I don't really drink coffee, but I do drink tea. Special thank you to all the viewers and subscribers out there. The channel continues to grow because of people like you. And lastly, share the videos with anyone you think that might find value in the content as well. Those are all the ways you can help out the channel. Now, this is the Vested Interest Stock Screener. This is the criteria we're going to be running through in the video here. Must make it to make it onto my watch list. It must meet 5 of 8, right? So any 5. Now, this one down here is for financial companies, highlighted in green here, and then it would be 6 of 9. So price to book I throw in for financial companies, specifically around banks and insurance companies. You can use price to book for any company, just don't blindly use one as fair value. Make sure you're comparing the price to book of the company to its historic averages as well as other companies in the same sector. So something like Texas Instrument, you might want to compare it to like a Qualcomm, that's another chip manufacturer, or one of the many Intel would be another chip manufacturer, or one of the many other chip manufacturers out there, right? Then you'd look at their price to book compared to Texas Instrument. All right, let's get back to Texas Instrument. Check them out on their homepage, www.ti.com. That is their homepage where I pull this information from. We design, manufacture, and sell analog and embedded semiconductors that are the essential building blocks of electronic systems. With more than 80,000 products, we have the most comprehensive portfolio of general purpose analog products, as well as full breadth of analog and embedded products that help our customers create differentiated applications, right? So they're a information technology company, really semiconductors, chip manufacturing. That's really what they do. Here's some of their products that they touch on in different industries: amplifiers, audio, battery management ICs, clock and timing, data converters, DLP products, interfaces, isolation, logic and voltage translation, microcontrollers, MCUs and processors, motor drivers, passive and discrete, power management, RF and microwave, sensors, switches, multiplexes, wireless connectivity. So they are in a lot of different sectors, providing a lot of different equipment and technology for those different sectors. Now, the reason we are taking a look at them, down 4.91% on the day, a big drop. We are talking about Texas Instruments Incorporated, ticker TXN, again out of the information technology sector, closed out the day at $177.34. 52-week range as low as $159.11, as high as $220.39. Not quite to their 52-week low yet, but getting very close here. Now, they do have a market cap of $161.365 billion, a beta of 0.96. PE ratio seems very so less volatile than the overall market. The market being one there. The beta is the volatility of the market. That's, the up and down of the market. Whenever you see volatility, that's what this chart is showing you, right? The volatility throughout the day. Looks like it started out trying to go up, then pretty much a down, recovery towards the end of the day, down again. That's the volatility of the market. PE ratio $34.10 per share, very elevated PE, price to earnings there. EPS is at $5.20. Earnings date coming up in April, sometime between the 21st and the 25th, sometime in that window there. Forward dividend $5.44. They are quarterly payers, so divide by 4, though we will see that here towards the end of the video. Dividend yield starting at 2.92% if you were to buy them now. 1-year target estimate of $204.70. So according to Yahoo Finance, they do not see this getting back to its 52-week high. Jumping over to the right here, I like to look at dividend yield theory to see if the company is potentially undervalued. Just a quick check. It's not an end-all be-all. But to do that, you look at their 5-year dividend yield average at 2.64%. You compare it to the current 2.92, or over here 2.94, 2.92, same number. Since it is higher than their 5-year average, that speaks to undervaluation, at least according to dividend yield theory. Now, payout ratio is elevated. This is not good, 101.15%. So to be able to maintain their dividend, they are doing some things here. They're either issuing shares or they are paying out of cash on hand. Neither one of those is really good. So this is something to keep an eye on. I like 75% or under, right? We want them to have a much lower payout ratio so they can increase the dividend over time and it's not in danger of being cut. So this is not good. Dropping down to free cash flow, I want growing free cash flow over time. Because typically, if a company has growing free cash flow, they can do some things with that debt. They can raise dividends, which this one shouldn't be if their payout ratio is so high. They can pay dividends. They can buy back shares. They can pay down debt, make acquisitions, or reinvest back into the company. Now, looking at their free cash flow going back to December 2021 here, you can see $6.2 billion in free cash flow. December 2022, $5.9 billion. So a bit of a drop there. Further drop in 2023 down to $1.3 billion. And it looks like maybe slightly up in 2024 to 1.4 billion. They are pulling shares out of the market, 527 million in 2021, 3.6 billion big repurchase in 2022, 3.6 billion, 2023, 293 million, and 2024, 929 million. Now, jumping over to stockanalysis.com, this is another source I go to for information. You go to any sources that you like. I just recommend more than one source so you can make sure the information you're getting is accurate and up to date. As you can see here, price targets were last updated on January 24th. So we're a little over a month past that. So that's pretty recent. But again, it is a little outdated, a little over a month. And with the pullbacks in the market, right, that could be a big month. Nonetheless, a lot of things have happened over the last month and a half. So that's why I recommend more than one source, right? So you can make sure the information is up to date and accurate. 21 analysts have taken a look at this. They call it a consensus hold, low estimate of $150, which if it dropped down, that would represent to the low estimate of 150 from 177 and 21 cents. That would represent a 15.35% decrease from where it currently sits. Average estimate of $206.71 is pretty close to what we saw with Yahoo Finance, around 204 for them. And this would represent, the 206.71 would represent a 16.65% increase from where it currently sits. And if it happened to hit their high of $298, that would be a 68.16% increase, and you could collect that nice 2.9% dividend yield along the way. Well, as long as they maintained it and didn't cut it. Like I said, 100% payout ratio or 100% plus, that's too high. Looking at statistics here, I like to look at return on equity and return on invested capital. I like 10% or better for both of these metrics. Return on equity at 28.40 beats the 10% I'm looking for there. Return on invested capital 11.15%, again, beats the 10% I'm looking for there. They got to get both of them to get a check, so it will get a check there. EPS growth, I like 5% or better forecasted over the next 5 years. They're at 18.50, so it beats that metric. Revenue growth is one of the ones I do more look at when I do more of a deep dive, but I like to add it in here just so we can see it. Looks like they're projecting 10.7% revenue growth. All right, let's look at the dividend history here as we wrap this one up. Quarterly payer, as we mentioned, payout ratio elevated, 104.62. So that is too high. We want this to come down. Again, I like under 75%. Dividend growth of 4.72%. I question if they should be growing that dividend over time. Wendy, you can leave that there if you need to. I question whether they should be raising this dividend over time if it with such a high payout ratio, right? Should they pause this or should they even cut it? Growth of 10 years, buyback yield is negative. We want that to be positive, so it looks like they're buying back shares, but they're buying back shares when they maybe are a little overpriced. Negative 0.33% on their buyback yield. Shareholder yield at 2.73%. They do pay out off schedule. Most companies start in March. They pay out they pay out February, May, August, November. So I like that they're off schedule, but I don't like this. Going back to July 2022, they were paying $1.15. October 2022, they raised it up to $1.24. October 2023, they raised it up to $1.30. And most recent raise, October 2024, up to $1.36. So they are raising it, but I question whether or not they should be. All right, let's check out the screener. Understand the business. That's where we start again. They're a chip manufacturer, semiconductor manufacturer in the information technology space. So that's the check there. Check out their homepage if you want to know more about Texas Instrument. Growing free cash flow. Nope, up and down. Growing dividend, yes, but I question whether or not they should stop that. Dividend payout ratio is way over 75%, so no check there. Dividend yield theory says they're potentially undervalued. Check there. It is not quite within 15% of a 52-week low. Return on invested capital, return on equity, both over 10%, so check there. And earnings per share growth was well over 5% at 18 plus, so check there. 1, 2, 3, 4, 5. This one would make it onto my watch list, but if I'm being honest, it's not on my watch list. I've looked at this in the past. I don't like the payout ratio is so elevated. Some of the other metrics, when I looked at it, I didn't really like it. So I took it off my watch list. It did make it onto my watch list previously, and right now it would still make it onto my watch list. So maybe it's worth looking at the finances again. It's been a while since I've done that. So take it with a grain of salt. Let me know what you think of Texas Instrument in the comment section down below. And that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of Texas Instrument. Let me know what you think of the video. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Texas Instrument you'd like me to cover in the stock pick of the day video series, drop it in the comment section. I'll work it in the rotation on a day it pulls back. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm only sharing my opinion. Invest journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable with. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.